Introduction to Options Trading, a seed for additional streams of income, presented by Dana Trades. All rights reserved. Disclaimer: I am not a registered investment or tax advisor or a broker-dealer. This presentation is not intended to be investment or financial advice or a recommendation to purchase any specific security. Please consult a financial professional before making any investment or trading decisions. This introductory course includes 4 modules. Module 1 provides an overview to options trading. The purpose of the overview is to cover broad concepts and general terminology in order to help you begin your foundational knowledge of options trading. Module 2 covers general technical analysis. Module 2 allows you to understand more about candlesticks and what they may tell you about a stock's price movement during a specific time frame. Module 3 will recap actual trades that demonstrate how I personally utilize options contracts to create income. And finally, Module 4 will review steps that you can take today. Yes, today, to get started in your options trading journey. Be sure to watch each slide and read the footnotes in addition to listening to the audio in order to take full advantage of the materials. Module 1 Overview. Can you spot the patterns? In the stock market, stock prices go up and they go down. From my perspective, options trading starts with spotting the patterns in those price movements. When a stock's price increases, what factors or candlesticks may signal that price may reverse and begin to decrease? And then, what factors or candlesticks provide higher probabilities that price is more likely to increase or decrease? This course provides an introduction to how an options trader may seek to profit from those stock price increases or decreases through the use of options contracts. The basics. What is options trading? At its basic definition, options trading is an investment strategy that allows the investor to potentially profit on short-term or longer-term price increases or decreases in a security or stock. Think about other investment strategies like commonly known retirement accounts such as 401ks and IRAs. Usually, these retirement accounts may buy securities like stocks or bonds and hold them long-term for an anticipated positive return on investment. Another investment strategy is real estate. Some investors purchase property with the intention to hold the property long-term to sell later. Other real estate investors may purchase property with the intention to flip it within months for an anticipated return on investment. In summary, what options trading, retirement accounts, and house flipping generally have in common is that an investor buys some form of asset or security with the intention to sell the same asset later for a profit. Benefits and risks. Benefits to options trading include that the trader can make money essentially from anywhere, therefore adding a stream of income without the need to even leave her home. Also, the potential return on investment or ROI is unlimited. In addition, the options trader or investor can potentially profit regardless of whether the stock price is increasing or decreasing, or if the overall market is bullish or bearish. Another benefit is that the barrier to entry is low. This simply means that depending on your brokerage platform, you could begin options trading with as little as $200 or even less. One benefit I especially appreciate is that I can predefine my risk, meaning I know exactly how much cash I could lose on a particular options trade before I even enter. Now, some options traders utilize margin, which is essentially a loan from the brokerage or trading platform. I caution any new trader to make sure they understand their margin risk if they choose that route. Of course, all investment strategies carry some level of risk. With options trading, the investor could potentially lose all of her investment money, or with margin, she could lose more. The basics. Let's talk more about options trading in 3 basic steps. Step 1. The investor speculates on the price direction and range of a security. Step 2. She buys an options contract that captures the price direction and range at a reasonable price with reasonable terms. Step 3. The investor sells the same options contract at a later time for an anticipated return on investment. Tip: practice restating these 3 basic steps. You may be surprised how verbalizing a new concept may help your learning process. Now, let's look at each step more closely. Step 1. An investor speculates on the price direction and price range of a security. Let's break that sentence apart, starting at the end and working our way backward. A security, for purposes of this training, we are focused on stocks or ETF, exchange-traded funds that are publicly traded on the stock exchange. If you recall, we talked about 401ks and IRAs earlier in the training, and that those accounts tend to hold securities, including stocks and ETFs. An example of stocks that are publicly traded include Amazon, Apple, Ford Motor Company. An exchange-traded fund is a basket of multiple stocks, usually in the same sector. For simplicity, I will refer to stocks throughout this training. Price direction simply means whether the price is increasing or decreasing. Range refers to by how many dollars and over what time period will it take the stock price to increase or decrease to a specific level. So, how can an investor possibly know whether the price of a stock will increase or decrease and by how many dollars or range and over what time frame? Well, she can never definitively know, but she can perform research and analysis to speculate as to the price direction and range. Speculation should be supported by some objective analysis, whether technical analysis or fundamental analysis. Technical analysis generally consists of studying past price data to identify patterns, while fundamental analysis generally entails a deeper dive into the company's performance as reflected in balance sheets, earnings reports, and product service innovation. We will explore basic technical analysis in Module 2. The basic step 2. Step 2. The investor buys an options contract at a reasonable price with reasonable terms. She buys an options contract by simply going onto her brokerage's online platform to buy the contract, also referred to as entering the trade or executing the trade. Just like our example in flipping houses where an investor buys a property with the intention to sell it later at a profit, in this case, the investor buys an options contract connected to her speculation on a stock price movement with the intention to sell the same contract later at a profit. An options contract is an agreement between a buyer and a seller that gives the buyer the right but not the obligation to buy or sell a specific stock at a specific price, called the strike price, on or before the contract's expiration date. Some important components or terms of the options contract include the parties to the contract, the subject of the contract, the quantity involved, and the cost of the contract. For purposes of this basic training course and this step in the process, you would be the buyer. and some other options trader is the seller. Keep in mind that the options contract and the stock are not the same thing. An option is defined as a derivative because its value is directly tied to the underlying stock. An options contract represents 100 shares of the underlying stock. Also, the premium, or the cost of the options contract, is your financial investment. As the options trader, you choose the stock, you choose the strike price, you choose the expiration date, and you can even choose how much you are willing to pay, or premium, when you buy the options contract through your brokerage. This is the level of control that you have when entering an options trade. An options trader may question, how do I know if the contract price, premium, or the terms, strike price and expiration, are reasonable? These factors are based upon the investor's analysis as discussed in step 1. If her analysis suggests that a stock price may increase $5 within the next 2 weeks, it is probably not reasonable for her to purchase a contract with a strike price that is $10 higher than the stock's current price with an expiration date of 2 days. Lack of reasonableness in contract selection will lessen your probability of profit. The basic step 3. The investor sells the contract by going back to her brokerage platform to exit her options contract and enter a sell order. At this step, you are the seller. The sell order can include the specific price that you will accept for the contract, referred to as a limit price. Remember, limit prices may not be filled if no buyer agrees to your price. Or you can enter a market order, which essentially means you will accept whatever price the buyer is willing to pay for your contract on that day. Just like our example in flipping houses, an investor buys a property with the intention to sell it later for a profit. Remember, the goal here is to buy an options contract with the intention to sell it later at a profit. Therefore, the options trader should be strategic when she first enters the trade to make sure that by the time she wants to exit, she has a higher probability of exiting with a profit. A later time speaks to whether you are a day trader who buys and sells hours later, or are you a swing trader who buys the options contract and sells days or weeks later. That is simply a matter of style and preference. As you learn more, you'll be able to identify which style is more cohesive to your lifestyle, your emotions, your goals, and your risk appetite. Return on investment signifies whether you made a profit or lost your money. Profits are not guaranteed in options trading, just like any other investment. Sometimes you lose money. If your contract sell price is less than the premium or your financial investment, the percentage would be a loss on your investment. The quality of your analysis and strategy execution, including contract selection, can help minimize loss and improve the probability of a profitable trade. Nevertheless, trading is about probabilities, and some losses will be par for the course. After you grasp these foundational principles, definitely take advantage of our advanced courses on strategy and execution. Recap, we just reviewed options trading in 3 basic steps. Step 1, the investor speculates on the price direction and range of a stock. Step 2, the investor buys an options contract at a reasonable price with reasonable terms. And step 3, the investor sells the same options contract at a later time for a return on investment. Let's keep going to see how all of these basic concepts work together. Continuing with our review of basic concepts, options trading begins with the underlying security or stock generally speaking. A security in this context simply means a stock or an exchange-traded fund that is publicly traded on the stock exchange. Many retirement plans like 401ks or IRAs are made up of some holdings of stocks and or ETFs among other assets. Examples of stocks include Ford Motor Company, Apple, Bank of America. These stocks are shown on your screen as their abbreviated stock tickers. ETFs include XLU, which is a basket of utility company stocks, and SPY, a basket of the top holdings of the S&P 500 index. Using technical analysis or fundamental analysis, an options trader may speculate as to the price direction and range of a stock. Whether some evidence supports that the price per share of the stock may increase or decrease over a certain period of time should be supported by either technical or fundamental analysis. Based upon her analysis, the options trader will choose an options contract in relation to the price direction she identified. She may choose a call contract if she believes the price of her underlying stock may increase. She may choose to purchase a put contract if she believes the price of the underlying stock will decrease. One commonly cited word association to remember the difference is to call up or to put down. Remember, the option contract is directly correlated to the underlying stock or ETF. The option itself is a derivative of the security. Simply put, the option cannot exist without the security or stock. When the investor chooses her contract, her research should determine which strike price she chooses, as well as the premium she is willing to pay. Other factors that some options traders consider when choosing the contracts are open interest, volume, and the Greeks, including delta, which suggests the impact on the value of the contract with every dollar increase or decrease in the underlying stock, as well as theta, or time decay, which suggests how much the value of your contract may decrease with every passing day. The strike, the Greeks, and expiration date are factors that may impact the premium, also known as the cost of your investment. Think about it. The more favorable these terms are, the more likely your premium will be more expensive. Finally, the investor seeks to sell the options contract, which is based upon that underlying stock, at a future time or date. If the price of the underlying stock moves consistent with the option trader's speculation as to price direction, timing, and range, she may sell at a profit. She may sell at a loss if the underlying stock does not move consistent with her research before the expiration date of the contract. Or her contract may expire worthless, which means the expiration date has arrived and she was unable to sell her contract at all, and therefore she lost all of the premium or financial investment. Keep note that assignment may be triggered when the buyer of an options contract exercises her right to buy or sell the underlying security. Review your trading platform's rules on assignment, particularly if you are using options trading as a strategy to acquire and accumulate stock, or if you simply want to avoid the risk of being assigned a stock you simply don't want. Now let's take a look at an actual options chain, which is simply a listing of the options contracts available on an underlying stock. In this case, we're using Apple. Many brokerages use the options chain to show the options trader the available contract strike prices, expiration dates, as well as other information she may find relevant in choosing her contract. Now, the layout for your trading platform may be different than what is currently shown on your screen, but generally, the same information will likely be available. Depending on the brokerage platform you use, the investor will go to the Options Chain tab and choose the contract with reasonable terms based upon her research, as we discussed in Step 2. In the top left corner, you have the underlying stock or security. In this illustration, Apple, stock ticker AAPL, is the underlying stock. Recall that the entire options trade is based upon the price movement of the underlying stock. On the left side are call contracts. Recall from the previous slide, an options trader may choose to buy or be long a call contract if she believes the price of the underlying will increase. On the right side are puts. An options trader may choose to buy or be long a put contract if she believes the price of the underlying will decrease. There are other advanced strategies, including being short a call or short a put, as well as multiple leg trades like butterflies and iron condors. Keep those in mind as you progress in your educational journey. Next, you see the bid-ask spread. The bid is the highest price buyers are currently offering to purchase that particular options contract at that particular time. The ask is the lowest price sellers are currently accepting to sell their contract at that particular moment in time. This data helps you determine premium. Again, the dollar amount you want to pay for the contract or your monetary investment. You can either give the seller the price they are asking for, or you can wait and see if the seller will come down to your bid or your offer for the options contract. Remember that we discussed each options contract represents 100 shares of stock. Therefore, you would multiply the premium or the price by 100. You see the expiration date listed in the day, month, year format, and the strike price listed in the middle. Now let's put these concepts together to actually read the terms of an options contract. Let's look at the call side, specifically the 185 strike price, reading from the right to the left. So for this call contract, the strike price is 185. The expiration date is May 31st, 2024. For this particular contract, the sellers want $770. The buyers are currently offering $755. The last contract that sold at this particular time was for the price of $767. The open interest was over 15,000 and the volume is 81. The simple difference here is that for open interest, this means the total number of outstanding contracts that have yet to be closed, settled, exercised, or assigned. Volume, on the other hand, simply is the total number of contracts traded during this particular time period. Moving on to theta, which is time decay, simply meaning that at this point, this contract will lose $7 of value with each passing day. Gamma. Gamma simply measures the rate of change of the delta for every dollar change in the underlying asset's price. Basically here, after a $1 increase, then each delta will increase by $3 at this snapshot in time. And lastly, we have the delta, 91. This basically means for every dollar increase in the underlying stock, the contract will increase $91 in value. It's time to apply your knowledge. Answer each question in the 15 seconds allotted. At the expiration of time, the correct answer will appear on your screen. Identify a risk of options trading. Name 3 stocks and their stock tickers referenced in this training. The options contract is a derivative of the blank. How might an options trader speculate as to the price direction and range of Amazon stock? What information may impact the price or premium of an options contract? Congratulations, you have completed Module 1 of the Introduction to Options Trading course. Consider re-watching, re-listening to this module at least twice before moving on. Repetition may help you grasp these new concepts. Likewise, take advantage of all the education offered on your brokerage platform. This will help jumpstart your educational journey. In Module 2, we will build upon Module 1 with a review of the basics of technical analysis.